Prices of apples or computers or cars, they don't care whether the demand comes from the private sector or from the public sector, from the government. For them, it's the same. If there's more dollars chasing the same amount of goods, then prices will rise. And it doesn't matter whether those dollars are coming from private individuals or from the government. It's the same thing. So if the Fed is raising rates, but the government keeps on spending, running those huge deficits, you're going to have inflation. Before we dive in, I think we should say that silver is doing pretty well, even though we're seeing a pullback right now as we speak. Silver has broken out in no uncertain terms, and within a couple of days, it got as high as almost $35 an ounce, which is a price we haven't seen for 12 years. So that's a great thing. I feel vindicated because, you and I, we were talking about silver and investing in silver back when it was trading around $22 an ounce. And now it's what, 50% higher. Even after this current pullback, it is still trading 50% higher than it did last year. And I think it is outperforming the S&P 500 and it's outperforming the Nasdaq, I think, this year. So we were right.
Yeah, it's been doing very well. And that was exciting to see it get up close to 35. Silver is up a lot over the last year, as you had pointed out. And I think everyone should be very happy with the gains that we've seen in silver.
So I made a video because it was so important for me to mark this event and to explain why I think that this breakout took place right now and how I think that things will work out in the future. So my thesis is that if you compare the price action in gold and in silver during the summer, then you see that gold kept making new highs while silver was lagging behind. And many people in our community were kind of frustrated because silver wasn't doing as well as gold. And it seemed to me as though speculators, and I'm thinking about private speculators, not the banks, I think they were betting that gold is going to have a meaningful correction. And I was thinking that this could happen because it was approaching an important technical barrier. There was a trend line, which if you connect the top, the 1980 top in gold, together with the 2011 top on a logarithmic scale, then there is resistance for gold around 2670 per ounce. And I was expecting it to encounter some resistance at that zone. I was expecting kind of a correction, a pullback. Eventually, we didn't see a meaningful correction. It retreated to 2600 and then it charged again at that line. It just managed to cross it. And I think that, certain shorts, this is not the entirety of the short position, which is huge. I'm talking about just certain speculators who were shorting silver. I think they panicked when they saw gold go through that line and reaching 2700. And I think they bailed out. They just cut their losses. And this is what propelled silver above $32 an ounce. And it closed at 33.7, which is tremendous.
Yeah, on Friday, that was exciting.
Yeah, that was a tremendous move. Now, I expect that there's going to be a pullback because we've seen this many times, how the banks try to regain control over the market. They just let it run for a while until all the excitement dies out, and then especially if there is a pullback in the stock market. If there's a red day in the S&P 500, then it's kind of a good opportunity for them to slam the price and try to take it back down. But I was thinking, so long as the price of silver doesn't fall below $32, which I consider to be the breakout level, then we're fine. Okay? So expect a lot of volatility. That's part of the game. In my videos, I use all sorts of, images of a roller coaster, images of,
Yes.
of a rocket taking off, because I'm trying to illustrate that when such an undervalued asset is being repriced, you should expect volatility. This is the volatility we were expecting. So there's nothing surprising about it. So we we're starting to see up $2, down $1 days, crazy things like that. And perhaps we should get used to that.
I think that your examples in the videos are really good. We are on the ride now, folks. And but we were up, I think it was about $2 on Friday. And now, we're going down on the roller coaster a little bit. And good call on the gold price level at 2670. Right now we're sitting just over 2700. So it looks like it's holding pretty well just above that level.
Now, what we saw in silver, I think it was a bit of a short squeeze. I think a few speculators got squeezed and had to chase the market to get out of their positions. This is why you saw such a jump. But it's not the silver squeeze. It's not yet the silver squeeze because the banks themselves, who own the majority of the short position on silver, the monstrous short position on silver, they're not backing down yet. And they've been shorting it all the way up. As the price was rising, they kept on shorting.
Which is a little disheartening for me. I was hoping to see some of them trying to unwind these positions, but they got about the last I had seen 408 paper contracts for each ounce of silver, which is, really allowing them to push this market around with having very little exposure to the actual physical silver, whether they have it in a JP Morgan vault or they're borrowing it or anything like that. They just don't have to have that much of it to pull these tricks. So that was kind of a bummer. And I'm guessing that they're thinking they're just going to get a bailout, if this whole thing really turns upside down on them. What are your thoughts? Do you think that we might see them start to unwind these positions like before the end of the year, or you think they're just going to hang in there?
Look, they can't unwind those positions without the price exploding.
Correct. Which is
So
what I'm hoping for.
the only way that this ends is if people demand delivery of physical metal. Because if people don't stand for delivery, then they can always increase their short position more and more. And the silver squeeze happens when someone stands for delivery and they can't supply the metal. And then the market panics, and then everyone wants their physical. Now, the COMEX will never default because there are provisions in place in order to prevent that default. If there isn't metal to deliver, then they can force contract holders to settle in cash. But it doesn't matter because if you were hoping to get physical silver and you got settled in cash, they forced you to settle in cash, then you have to go get that silver somewhere else.
Correct.
So
So
the
that,
market
yeah, the
gets
demand has not gone
away.
away.
Yeah. The moment that the market realizes that there's not enough physical, that's the meaning, the essence of the silver squeeze that we're talking about so much.
And just to add to that a little bit, they had potatoes on the commodities exchange a long time ago, and they ended up pulling them off the commodities exchange. And it was exactly what Orrin described. They just had to pay out all the contracts in cash. And so that is something that we could be looking at.
You know, a lot of times I hear people saying, oh, so there are shorts. That's meaningless because for every long, you need a short. So if there's a large short position, that's only because there's also a large long position, an equivalent long position. Now, this is a saying which is technically correct, but also extremely misleading. This argument is though for every long there has to be a short, and therefore there is such a huge short position on silver. It is extremely misleading. Why? Because if I, for instance, want to go long silver, if I want to buy a long contract
Okay.
and the bank is not willing to sell it to me, in order to sell it to me, they need to create the equivalent short contract, right? If the bank is not willing to short silver anymore, then I have to buy it from someone else, someone who already has a
Good
contract,
point.
right?
Yes.
And if that person doesn't want to sell it to me, then I need to offer a higher price in order to give him an incentive to sell it to me. So the fact that the banks keep shorting silver prevents the price from rising. That's exactly the point. By shorting silver, they are creating artificial supply. Some people, they just don't get it.
Well, that was I think that was a good explanation, and I appreciate you pointing that out.
And there's a saying, a very important saying. It goes like this: price is set at the margin. Think about it. If you have 101 buyers and only 100 sellers, yes? So the
Yes.
first 100 buyers buy from the first 100 sellers, and then the last buyer doesn't have someone to buy from, then he needs to offer a higher price to incentivize someone to come along and sell it to him.
I see. That makes sense.
And what the banks have done for decades, they did not allow that normal market function to occur. And also, this is why you're seeing such huge volatility. Normal markets don't jump like ridiculously on no big news. It's not as though suddenly we discovered that there is not enough silver. We've known for years that there are deficits in this market, that demand is greater than supply. It's not something new, and yet the price lingered around 20 something dollars an ounce. But now, suddenly, it jumps because when you don't allow something to happen gradually and naturally, then you get those violent reactions. And if you look
That,
back at how the way silver moves, it always moves violently, which is, another indication that something is not right about this market.
that's a really good point. No new information came out. We saw it move like 7% in one day, which is pretty crazy. The price, in my opinion, is still artificially low. And something that I think we haven't seen yet that you and I had discussed in the past is as I don't think that we've seen significant retail investor interest yet. Because when we do, the investment grade, 3 nines fine, 4 nines fine, bullion, it's really going to disappear if a bunch of people start rushing into the market. And I think when we see that, when we see the FOMO set in, the kind of the panic set in, and everybody wants to go get their piece of the pie, is when I think we'll really see the silver squeeze start, to a degree where it becomes somewhat unstoppable, and we'll start to really see some big price increases.
Now, you've asked me a question, a very good question about inflation. And
Yes. Do you think that this recent silver and gold breakout that we've seen might indicate more inflation?
there are analysts out there who argue that gold has the ability to predict the future. And
Yes.
if you think about what happened in 2020, we've seen after the Federal Reserve started easing and printed the trillions of dollars, gold jumped in the summer of 2020 and it reached $2,000. And that was before inflation really started. I mean, before it translated into consumer goods. So gold kind of predicted the tremendous inflation that we've seen during 2021, 2022.
Yeah, that is a good indicator.
So perhaps the rise in gold right now is a harbinger of future inflation. It's true that the Fed has started easing a bit, just 0.5%. But perhaps gold is predicting that we're going to have some kind of a recession, which will force the Fed to ease some more and perhaps resume QE. So perhaps gold is, so to speak, seeing that the Fed will have no choice but to ease tremendously and is reacting to that. Now, boy, oh boy, if we're going to have another wave of inflation, how will it look? Because, just earlier before we started this show, I was having a look at what happened during the 1970s in terms of the CPI. And in the 1970s, we've had three large waves of inflation. The first one, well, it started during the 1960s, but it topped in 1970 at around 6%. And then it started falling back again. It went to, I think, around 3%. And then you had the second wave around 1975. It went all the way to 12.5%. Then again, inflation, the rate of inflation fell back to around 5%. And then you had that last wave. That was the big wave. That was when gold and silver really shot up and inflation went all the way to almost 15%, and it topped around 1980. So we need to look at this case study of the 1970s, and I think we're going to see the same dynamic playing out again. And I'll explain why. Because when the Fed notices that inflation is rising, they're most likely to react by tightening, and then inflation may cool down a bit. But then they tend to make this mistake of easing again. When they see that inflation goes down a bit, then they start easing again. And then it starts rising again. Inflation starts rising again. And you get another wave. In other words, they never really kill inflation. They never tighten enough in order to kill inflation. Because tightening, uh,
Yeah, it slows down the economy.
yes. So you have pressure from the administration and you have pressure from the business community to ease. I think we're seeing that exactly right now. There are pressures to ease, even though inflation hasn't been beaten.
I think you're right. I think that Wall Street has been pressuring them. I think that they've been panicking about what's going on with the commercial real estate market, and they've been applying a lot of pressure on them. I appreciate that you brought up the inflation in the 1970s. It was really brutal. And, I don't personally want to experience something like that, but it's something that everyone should consider. It could get really bad like it did in the late 1970s.
I'm thinking that it could get a lot worse than what we've seen during the 1970s. Because back then, if you think about it, debt to GDP wasn't as high as it is today. And I think Congress had a lot more fiscal responsibility than it has today. And also, the way we measure inflation was quite different. After the 1980s, the way we measure inflation was changed entirely. And nowadays, although it's the same CPI, it's still called the CPI, but I think it downplays inflation tremendously. So right now, I think when inflation topped around, I don't know, 9%, how high did it go this time?
I think it was close to that.
The true rate of inflation must have been 20%. You know, that's my personal experience when I check to see by how much prices have gone up here in Israel.
For us, food has gone up a lot. It seems like a lot closer to 20%, and in some cases, maybe even higher. Um, for a long time, a lot of the like fast food places, which a lot of people make fun of Americans for, but would have $1 options on their menus, a dollar hamburger, or maybe a little chicken sandwich, a small size chicken sandwich that was a buck, or like a mini frosty, just like a milkshake basically. That was a buck, and yeah, nobody has anything for $1 anymore. You used to be able to get a loaf of bread for 99 cents. I mean, for years, you can't do that anymore. So everything is going up and wages are not keeping up. And it's all over the country. Everyone's experiencing the pinch from this food inflation. So it's happening here too. Um, it's pretty concerning, that they haven't gotten inflation under control. I know a lot of folks felt like back in the rate hiking cycle that they didn't go high enough, that they should have kept pushing the rates higher until they really got it under control. And I think that you hit the nail on the head. They caved in to pressures from Wall Street and decided to, stimulate the economy by dropping the rates. And we'll just have to see where it goes from here. But it's pretty concerning, what we could be facing in the near future.
Look, as I told you, I think last time, I think the main driver of inflation nowadays, it's not the Fed, it's the federal government, which is spending like a drunken sailor. Because in order to beat inflation, truly beat inflation, rates need to be high enough so that the private sector cuts down, doesn't borrow as much as it used to rein in demand for goods and services. But at the same time, government needs to cut its spending as well because prices of apples or computers or cars, they don't care whether the demand comes from the private sector or from the public sector, from the government. For them, it's the same. If there's more dollars chasing the same amount of goods, then prices will rise. And it doesn't matter whether those dollars are coming from private individuals or from the government. It's the same thing. So if the Fed is raising rates, but the government keeps on spending, running those huge deficits, you're going to have inflation. So it's not in the hands of the Fed anymore. Okay? So I think that we've seen the first wave of inflation. It's over. We're probably entering the second wave of inflation. I wouldn't be surprised if it starts right after the election in the United States. I think people are kind of in a waiting mode. They're waiting to see the results of the election and they will react accordingly. Now, I wish I could say that we have one candidate which has extremely inflationary policies and the other which is more conservative. But and though of course I support Trump, I think my heart is with Trump. But unfortunately, I don't think he's a fiscal conservative. Although his policies are not as inflationary as those of the Democratic Party, I think his policies are still going to be inflationary to a certain extent. He still believes in growing the pie and doing it by, borrowing a bunch of money and government spending and, trying to stimulate the economy. He still has this way of thinking. And I think he doesn't realize that it doesn't work in an inflationary environment. Thank you for listening to the Silver Hermit podcast. If you like this content, please donate in the link which appears in the description below. Please subscribe to this channel and share it with your friends and family. Hit the bell icon to be notified whenever I release a new video. Remember, I'm not a licensed financial advisor. This video is intended for general informational purposes only and should not be regarded as investment advice. Before taking any investment decision, please consult with a professional financial advisor who may assess your personal investment objectives and needs.